Right, we are up and running. Sorry, I was just watching the screen over there. Okay, I'm just trying to get charts back up in a minute, so no charts just at the moment, which might be useful when it comes to risk management type stuff. But I thought we'll try and cover the questions that have come in to start with, and then that'll perhaps lead us on to any other discussions as we go through. So yeah, I'm just waiting to see if my charts can load themselves up. Right. Now you've got a bit of everything on there. Right, there we go. Sorry. There we go. Right. I'll let that work itself out, sort itself out for a minute, and then we can get back to it. Okay. Right, a few questions from Jason, so thanks for throwing those ones in there, Jason, and we'll try and cover these. Right. Correct me if I misinterpret any of these as well, because I think I get where you're going with this, Jason, but I may have misinterpreted this. Sorry, my charts are opening all over the place and not where I want them. There you go. Right, I can see at least now. Okay. Right, when evaluating risk reward, of a particular trade type, how do you factor in the difference between the actual risk taken at the point of opening the trade and the actual losses for that type of trade over time? Is average loss more important? More or less important metric than initial risk taken on the opening of a trade? For me, I would see it as the initial risk that you take when you're opening a trade is really key, because that's what you're willing to lose, right? So your average loss, if that, or even loss on a trade, if that differs from the amount you are willing to risk to start with, that suggests that there has been a different result to the trade than your initial plan. Yeah, whenever you enter a trade, ultimately you should know where your stop is. You should know where your target is. So straight away, you've got an expected risk reward on a trade. You know what it's going to cost you if it goes wrong. So if you've got a different loss on a trade to what you would have expected to lose had the trade gone wrong initially, well, you've got to ask yourself, why is that? Yeah, is this a case that, I don't know, for example, you said, I'm going to risk 10 ticks on this trade, and actually you've got out for a 5-tick loser because you thought, I don't really like it. For me, I don't think that's the right way to do it anyway. If you're willing to risk 10 ticks, there should be some reasoning behind that. So if you've got whatever reason it is that says it's 10 ticks of risk now, there's not a great deal that can really change to suggest it should be anything less than that. So for me, the key bit is more the risk that you're originally willing to take, on the basis that if this trade goes wrong, and this is where you've got to think about it, the ones that are just straight wrong aren't going to give you a bit on side and the possibility to scale out or anything else like that. You buy it here for whatever reason, your stop's here, and it goes filled, stopped. So you're going to take that entire loss on the full size as well, which is also another thing to consider. Let's say this was a trade idea that you were looking at. You're going to buy it there to make this easy. There's your 10-tick stop, and you put a bid for 10 lots here. Now the market comes down. Your risk on that is 10 times the 10-tick stop. So your risk is 100 ticks, right? Nice and easy. What you've got to start to think about is what happens if you get filled 2? Because if you get filled 2, and let's say your target was a reasonably modest target here, and that's 20 ticks, well, you've got filled 2, and you've got 20 ticks out of it. So now you've taken a 100-tick risk for a 40-tick winner. Now, on the face of it, one trade, that's unfortunate. You know, not every trade you're going to get everything you want. It's a little bit annoying, but you have to look at the trade from that perspective. I don't mean you can say this is a bad trade. Ultimately, the objective of going from here to here before it goes here has worked. So the trade itself makes sense, it works. But you have to then, if over time you're finding that consistently you're not getting filled all 10, or it's a trade or a strategy where your objective is to try and scale in, let's say, and you're going to scale in there, well, you've then got to try and start to adapt this, because whilst it looks quite good on the face of it, you're like, well, I've got a 20-tick winner out of this. The ones that you lose, you will get filled and filled and filled and stopped. So you will lose the entirety on the ones that go wrong. So I'm a little bit unsure as to where you're getting the average or a loss that's not the same as your expected initial loss from, unless, I don't know, something changes within the trade. You can ask.
Well, I don't know whether it's relatable, but like the sort of concept of taking many small losses, right, as opposed to only getting out of the trade when you've been proven wrong. I've lost my point.
I think I know where you're going on that.
My brain's gone dead. Yeah.
You can simply cut the trade 3 or 4 times and take like
well,
$10 ticks loss and 10 tick loss and 10 tick loss 4 times, and then be net 40 down, as opposed to let it come all the way down and just take you out once at net 40 ticks. Is that what you mean?
I'll give you
yeah.
potentially where I think you're going with this, because I was talking to Adam about this, because tracking your performance on trades is never that straightforward.
Yeah.
And so he was always doing it on Journalytics or something that does it for him. And he was saying, actually, what he's doing now is just doing it manually, just do it on Excel. But rather than, let's say if this was the idea of the trade, you're going to buy it here. If he's had 3 attempts at it, then the risk on the trade is the cumulative of it, the risk that you took on all 3 for whatever you get paid out on the trade. That's definitely something that you have to make a discretionary decision on. Like, is this still the same attempt at the same trade again, or is it something different? In which case you've got to kind of look at it and go, well, if you've taken 3 attempts at the trade, you've lost on 2 and 1's worked, this may still not be that great a trade for you to have taken. I don't know if that's quite where you were going with it, but there's also that element of you see this quite often. It happens when you're in a range and people playing breakouts, that you're in a range there, and let's call this a 10 tick wide range. So the range is 10 ticks, and what people do is they're playing for the break towards the upside. So the market goes up there and they buy it here, doesn't work, and they take a 3 tick loser. Then it goes back and they take a 3 tick loser. Then it goes back and they take a 3 tick loser. Then it goes up and it finally goes. And let's say you get another 10 at the top. So now you've ended up in a situation where you captured the move and you've basically made 1 tick because you took 3 tick losers. This would be one where actually you're better off to go, well, just put your stop down here. Yes, if it goes wrong, it's going to hurt, but it's going to hurt once. And if it goes right, you don't have to keep taking those losses. That's the problem. That if you take the losses too easily, all you're doing is digging yourself a hole that you've then got to try and climb out of. And this move then has to be that much bigger. So that's got a similarity to it, that often you don't need to take a loss. And whilst people feel that they're protecting themselves by taking the loss, you're often actually doing the opposite, because you're just digging yourself a hole without ever being wrong. That's the nice bit about trading, that when you're right, you don't ever actually have to take the loss to start with. So there's no cost to being right. You just have to be willing to pay the price if you're wrong.
I suppose the other thing about the 3 attempts at the same trade comes back to what was in the video this morning is there new information each time you take that setup? So I take the attempt at that trade, so therefore it's coming to a level and you'll keep trying the same thing, that's the same trade.
Yeah.
So if you've got new information, order flow, something you see, I guess you could then decide what your criteria would be. Is that still the same trade, or is it now, would I consider that a separate trade?
Yeah, I think that's a very nuanced, that comes down to, are you still playing the same idea, or are you playing, or not even the same idea? Are you playing a certain strategy to play this idea, or is this now a new strategy to play that idea? And I think it's worth distinguishing between the two of those. Just because you might then start to go, do you know what? This way of playing this idea is not actually a good idea. Just do the other one. And if you don't get the chance.
Trying to fake the levels, playing the breakout of the move you're expecting.
Yeah, exactly.
I think it's really frustrating when you do that and you take several attempts. You're better off just sticking in it, and if you're wrong, you're wrong.
Yeah, exactly.
It's so frustrating.
Well, that's it. And
You've got the move right, but you
get paid nothing for it.
Yeah.
And the problem that you get then is you reach the target. All right, this would be a pretty crap risk reward trade, but you reach your target and then you start thinking, well, I've got to actually take this further. And so then you start aiming. You're aiming for something that was never part of the idea, but you feel the need to recoup, rather than just go, well, this was the right idea. And clearly what you're doing is you're playing the trade badly. You're not executing the trade right. The idea is good, but your execution's bad. At least then you go, well, that's what I need to work on then. I have created this. I can send this over, and I'm sure there are people who are far better at Excel than me that can make this much more whizzy and interesting. But what it was something that I tried to do was to take a trade, any kind of, so this would be sort of a straightforward strategy that you would have. I think this might come up later on in the week anyway. One thing to track the win rate of the trade over time. So does it win, does it lose? Nice and straightforward. But what I tried to do was draw a distinction between your expected risk reward on a trade. And I think risk reward's a pretty weak measure of performance on a trade anyway. which is then where I started to bring it into an element of actual risk reward. The idea of actual risk reward is this averages out the risk reward on all the trades that you've taken. So a trade with a reasonably, or it was like a positive win rate, is going to give you a higher average risk reward than you might on any individual trade that you take. Because in this example, you've not won 3. But in this example, if you've got a profit of an average of 63 per trade and a loss of 6.6, that's 3 trades divided by the amount of loss. That then gives you an actual risk reward of 9.5. So you can look at a strategy over time and go, well, if I average make this much and average lose this much, then that gives me an average risk reward of whatever. Sometimes it makes it a little bit easier to look through the basics of risk reward. People go, well, that's not a great risk reward. No, it may not be. But if you're winning 80% of them, a 1-to-1 risk reward on an 80% win rate is perfect. The hard bit is getting an 80% win rate on something, but there's nothing wrong with 1-to-1 risk rewards on trades. I send that over. The other thing that I've done with it as well is to give yourself a profit percentage. So the idea here is then to try and look at how close you get to achieving what you should have achieved. So if you take a trade that, let's say, these hypotheticals, you're looking for a 10-tick win with a 5-tick risk. If you get filled 5 lots and you get a profit of 40 ticks, so that's number of contracts times number of ticks, that's how I'm looking at it, then you've achieved 80% of what you should have got, because theoretically you should have made 50 ticks. So it just gives you a way of spotting potentially where maybe you're underperforming or you're not carrying trades, either because you're looking to take it too far. You may find that ones where you look for a much bigger tick or larger number of ticks, you don't ever carry, or ones that you up your size, you don't carry. So you can then start to go, okay, well, there's something I can work on here. You've got to try and work out what that is. But the idea is to give you a sense of whether you're actually achieving what you think you should. It's either a case that you're not holding for enough ticks when you decide it's going there. Secondly, it doesn't go there to start with, which is more a technical understanding issue. Or thirdly, you don't carry the size when you put on more size. And if you're not doing that, that's more of a psychological aspect of you're seeing this differently when you trade a bigger position.
How often would you sort of review it? Like, would you say 20 trades, I'm going to look into how it's been performing or how I've been executing?
I think
if you're seeing that this discrepancy between what you expect to take and what you actually take, at what point do you then drill down into that?
I think you could probably do, you certainly don't want to be doing it too frequently. I'd almost do it like on a monthly basis. You just get to the end of the month and go, look, what of my trades are performing and what aren't. The hard bit with anything like this is, this is kind of the way that you might assess the value of a strategy. It's quite hard to absolutely pinpoint a strategy, but that ultimately comes down to your ability to go, look, this is, strategy and an idea are slightly crossover things. But if your strategy is I'm playing a reversal from this area today, that should be similar to to another type of strategy that you use. So you have to have an element of discretion of what it falls into or what the name of your strategy is. Okay, so Jason, I guess the average loss would come when managing a trade and you move your stop, for example, below break even. But I guess you would suggest that probably wouldn't happen to be a properly executed trade. There's always going to be that tricky bit of when you move your stop. One thing I would say, don't move your stop to break even. The point you got in at has nothing to do with your stop. Your stop is where you think you're wrong. Wherever you got in was where you thought you were right on the idea. So the last thing you want to do when you come back to the point where you thought you were right is now assume that you're wrong. And that's essentially what stop is, your assumption that you're wrong on it. There's not that many trades that should not come back. And even if they do, there's not many trades that would invalidate your idea by just coming back to the price that you got in at. Coincidentally that can happen, but that should never be a reason to move your stop. Similar to the people who go with I move my stop to 1 tick on side, because at least I can't lose then, or at least I've covered my costs, that kind of mentality, or just below break even, so you're still taking a risk. Put the stop where the stop goes. There are going to be situations where moving your stop is a viable and sensible thing to do. You know, for example, you've sold it here, market goes down, you've got to the next level, it breaks the level, pulls back and starts to go again. I think if your stop was originally here, it would be pretty silly to not move it down to there. But that's always going to be a slightly discretionary thing. The last thing I'd do is go, oh, well, I sold it here, my stop's now there. Yeah, in my view, if once it's done this, if it does that, you're wrong on this idea now. It's not going to your big target. I don't need it to come that far to prove me wrong. I'm wrong, give it up. That's a bit where you'd almost have to look at those separately and go, okay, well, trades where I move the stop, less about the average performance of the trade, but start looking at when you move your stop, how frequently do you then get stopped out? Because one of the things you want to be trying to assess, which is less, I guess, slightly less numerical in a sense, is you want to actually look at, well, if you move your stop and 90% of the time you move your stop, you get hit on it, that suggests you probably shouldn't move your stop. Particularly if, and this, where whenever I'm tracking any trades that you take, you always want to look at the result of the trade at the end, i.e. if you got out of the trade, did it go to the target? Because if it does, and consistently it goes to the targets you've defined, that's suggesting it's the way you manage your trade and your desire to get yourself out of the trade is causing you a problem. If it doesn't reach the target, well, that suggests that technically you're not doing the trade right. You know, there's a problem with your technical understanding. You're asking for too much. So I think with any of them where you move the stop, or irrespective of the performance on the trade, just make sure that you make a note or track in some way whether the trade actually goes to where you thought it was going to go before it stops you. Right. Okay, Ralph, so on a slight variation on the taking the trade multiple times, should exit re-entry costs be considered when thinking about multiple attempts at a trade, spread, commission, slippage and fees? Personally, no. I think if you spend too much time worrying about those minor details, a bigger problem is going to be taking 3 attempts at the same trade, losing on the first 2 and then making your money back. The commissions, yes, maybe you've spent an extra $5 of commissions, but really what you've done is you've cut a $200 winner down to a $20 winner by taking multiple losses on it. That's a far more significant thing. And ultimately, the other thing on this, you can't get around costs to enter trades. You have to pay commission. It's what you do. There's no way around that. There is no possible way of putting a trade on without paying a commission. The spread is something that you can deal with by better execution. Slippage, you shouldn't really get slippage on entry to trade. You have a point where you're going to enter at that point. So I don't think there's much to be said on that. So broadly, no, forget that. I would suggest to start with, particularly when you're testing out, which is part of the next bit, forget commissions, forget any of that side of things. At the end of the day, if you can't make money, it doesn't matter what commissions you pay because they're always going to be a tax on your performance anyway. If you can't make any money, it doesn't matter whether you reduce commissions or not. So look at it like that. Right, I thought this was quite a good question because a lot of the stuff that I sort of discussed was more relating to, you know, if you're actually trading this live, trying to make some money, you know, at a stage where risk management really matters. Is there a rough timeline within someone's journey to implement various risk management techniques? So assume that there's little point in the maximum stop on the day when you're developing and testing trading setups. I completely agree. But you don't want to also test things before moving strategies to live. I would suggest you want to go on a progression phase here. One of the things that I always emphasize to people to start with, if you're on a sim and you're testing stuff out and you're experimenting with different ideas, completely turn off P&L. It's absolutely irrelevant. And you're not going to gain anything by watching the P&L on trades. To start with, you just want to be looking at an idea around, well, trying to work out what might be places to enter trades, what happens when you're in a trade, what your thinking is around why you take certain types of trades. Don't worry about the performance of them, but take the trades on. Go and test out, go and experiment what it's like buying the highs, trying to buy every dip, whatever it is. Work out what you're more comfortable with, work out what you like doing. Completely ignore performance. So less about allowable risk, although same point. There's no point in limiting the risk that you take when you're experimenting with stuff. Otherwise, you end up sort of walking away from ideas because, oh, it's cost me 300 quid. It's 300 quid of fake money. Don't worry about it. You know, just go, click the button, see what happens. By doing that, if nothing else, what you start to get is a sense of what you like doing. You know, a lot of people don't like buying dips. A lot of people don't like playing breakouts. You want to find out what you feel comfortable doing, what you actually enjoy, what seems to make sense to you. Once you've gone through that, and I kind of tried to break this up almost into, you could do this, you could see this as kind of 6 months, if you will. But at any point, I would suggest you have to then ask yourself, do you think it is viable to move to the next step? I think I probably should have done these in white, not black on the wording, but I can change that by the end, or before the end. So first one is just try and work out what it is that you do. Next month, test ideas out. The whole idea here in a second month is, can you actually define some trades that you can take? So do you have certain plays that you like to take? Are there certain ways of doing things that you lean towards? Are you, if you're inclined towards breakout trades, how do you play your breakout trades? Have you got multiple different strategies to play a breakout? That's the whole idea of, say, a second month, sort of just testing ideas out, so you can kind of get, yeah, these are kind of my set of tools that I've got, I can start to move this forward. Only after that point, and this is a phase that if you want to could take a lot longer than 2 months. Yeah, there's no point in going, right, I've done 2 months, I've got no idea what I'm doing, but let's add some risk management and see what I can do. Because all you're going to do is just limit what is already a very limited set of skills. You don't want to do that. If you don't feel that you've got anything, and a good test of this is something we'll come on to a little bit more later on this week and next week, is if you couldn't explain to somebody what to do and they could take that information, right, you've written it down, and they could look at that and go, okay, I know when I would do this and what I would do. If you can't do that and can't explain that to somebody, it's not really a strategy. I so often hear people like, well, I kind of look for a bit of flow and then, I try and buy or sell. It's not a strategy. What would I do if you gave me that information? Nothing. Or I could do whatever I do, but that's probably nowhere near the same thing that you're actually thinking it is. So what is it that you would actually do? That's the bit that you want to get to. If you've got to that point, then I would suggest give yourself a stop. Bring a stop in. So this would be a stop still on a sim, but bring yourself a stop and just make it a daily stop. Don't need stops per trade, as in you need to have a plan as to where your stop is on a trade. But I don't like the idea of a sort of set, well, it's 500 risk per trade, whatever it is. Bring in a daily stop and then start to see if the ideas that you have, if the trade strategies you have are actually viable within that stop. Now, that's probably an element of something we'll come to the next bit of your size management, because that's the bit that you need to bring in. You can have tons of fantastic idea trades that broadly, they've got a 50-50 win rate or better. The risk reward on them is 2-to-1, 3-to-1, 10-to-1, whatever it is. That's all great. But if you don't manage the size that you trade some of these trades with, they're not viable. I think there's a lot of trades that you can look at and go, well, I could buy that, it's probably going up. And if you give yourself a big enough stop, you'll probably get away with it. The problem with that is the one you don't get away with is going to be so damaging that you're not going to get over that in the long run. That's the whole point of a daily stop. The whole point of a stop is that you cap the downside so that your upside can sort of take off, which means then your losses on the downside are less significant. I don't like the phrase, cut your losses and let your winners run. I think it's a little bit too vague. What you more want to be thinking about there is not cut your losses, let your winners run. If you cut your losses, your winners have a much greater impact on your performance. So because I think people take that the wrong way. So you're like, oh no, I'm offside, cut, take a loss. Don't worry about it from that perspective. If you've got a daily stop of, let's call it 1,000, and you find a day where everything it runs right for you, everything seems to make a lot of sense, you get a decent move, you put a bit of size on, and you make 3 grand on a day. The point of that stop is not to limit you in any way, and you don't want to try and make this smaller to limit your losses. The point of that is that you're still enabling yourself to go 3 grand up, which now means the next day, if you lose, the impact of that is pretty small. So it's not about trying to just constantly minimize your losses. Constantly minimizing losses essentially just takes your ability away from making bigger money.
And do you see that as like an evolving stop loss? So if you make 3 grand that's above your, I think you did it in the video, like above 75% growth, so you're having a good day.
Yeah.
You don't want to lose $1,000 off $3,000 as opposed to go back all the way to minus $1,000.
Yeah, I think there has to be a line within the day where you go, right, I'm not going home, negative.
$1,000.
Yeah. But I think you should give yourself more leeway as you go up than less. I think what the mistake people make, let's say you're you're 3K up, that's bigger than a normalish type day. And what people do is they go, right, my stop on the day is 2.5. And the problem you end up with there is you don't want to go end up 2.5, you'd like to keep 3. So you then start taking really small risks on trades and you end up just creeping down. And before you know it, you're at 2.5 and you've just been 500 quid for no good reason apart from you didn't want to lose 500 quid. So it almost becomes a target, the 2,500. And it also means that then if an opportunity comes your way, you won't take the right risk on it because you're like, oh, if this goes wrong, it might lose me my 500. I think you're better off to kind of go, right, well, if you want to guarantee that you're on a winner rather than a minus, you go, okay, well, plus 1,000, I'm going home with that. It still gives you $2,000 worth of risk. At the end of the day, if everything's going your way and you're $3,000 up, there's a higher probability you're going to make another 1,000 before you lose 2,000. So look at it like that. Whereas if you give yourself too tight a stop, you'll either hit it in one go because you're of the view of, it's all going well, click, get into some trades, and one goes wrong and you stop. Or you try so hard to not hit it that you hit it anyway, which is always a horrible experience. So yeah, you're better off to almost, if you're going to chase your stop up, if you will, once you get over 0, increase your stop on the day by 50 pence for every pound your P&L goes up. So it always tracks on a kind of, I can't think what the way you'd explain it, but it's on a much lower trajectory. So you're always giving yourself more risk as you go higher, which at least means that you've got the capacity to take on the risk or take on the opportunity if it comes. But yeah, there has to be an element at some point of moving your stop up. The only other point would be, I think there is a lot of value if you top your best day to make sure you stay above it. Because there's going to be nothing worse than, I don't know, your best day's 5K, you get to 7 and you finish on 4.5. There's two things with that. One, you had your best day and now you've not taken it home. But two, if you've moved your top day from 5 to 7, well, that's a new target. So having that as a new target is far more valuable than the idea of, well, I should keep on taking risk. Yes, you might turn 7 into 8, but being able to go, yes, but this is my new target becomes a valuable thing. So if you get over your best ever day, I'd always say you make sure you stay above it. Even if you give yourself a reasonably small stop at that point and go, well, I'll wait for something special. And if nothing big happens, I'm pretty much done for the day. That's how I'd approach those types of ones. You don't want to pull back from that. Excuse me. Okay, so once you got to that point, if you feel that you can do it, I still wouldn't be too fussed on performance, but you can stay within the stop. If you're finding that you're just getting stopped out, well, that suggests it's probably more to do with risk management than it is to do with your actual trades, assuming that the trades are a good idea. If it's that they weren't getting stopped out previously and now they are, it's probably a risk management thing. If it's a case that, well, they weren't really working that great here, well, you've probably jumped the gun a bit too much on it. You don't restrict yourself before you need to. Think of it like that. The moment you move to here, you're just restricting anything that you're already doing. And if you're still not clear on what it is, the last thing you want to do is restrict something that's already, or that is still in its infancy, embryonic stage. You're not quite sure what it does. Next bit then, this would be then, I'd sort of view this as sort of split in half. This is trying to work out if you've got something that you genuinely think you can make some money with. The next bit would then be about making this realistic. Once you give yourself a realistic stop, and this is more just a guidance, that's what we would give traders. You get $1,000 starting stop. Still wouldn't expect to perform that much. If you can stay flat during this period, you can at least go, yeah, I'm getting somewhere with this. I'm not losing money, which is always a good goal to have, at least to start with. But it is ultimately then a question of, can you actually make money? With that, and the whole point here as well is to create something realistic. So if you hit your stop, you have to stop trading for the day. And if you don't stick to that, well, you're still not really getting anywhere. The whole idea is you've got to create as close as you can some element of realistic pressure that is vaguely akin to actually being live, because you can't hit your $1,000 stop live and go, well, that I wouldn't have really done that. Yeah, that money's actually gone.
I was only joking.
Yeah, exactly. The amount of times I've heard people do that, they go, well, I wouldn't have done that if I was live. You absolutely would have, because you've learned to do it on the sim, so you absolutely will. And that's also the point there. If you can be realistic with it and stick to your stops, you don't habitualize, well, I wouldn't have really done that, because nobody would have really done that stupid trade that happened to lose. But that one that you click 10 lots on the sim for absolutely no reason, it goes 20 ticks in your favor. Absolute genius idea. It's not. It's a terrible idea, but no one admits that you wouldn't have done that live either. So be realistic with your stop. What you want to be then doing is, you still got to keep on tracking your performance. Try and work out what it is that does work and what doesn't work. One of the best ways to take yourself from flat to profitable is not by learning more trades. The hardest thing to do is find new trades and new ideas. There's only so many new ideas you can have. It's often about being able to go, do you know what? This isn't actually that great an idea anymore. This trade doesn't really work. And often that's the case of people get quite attached to ideas that they like the idea of. And so they want it to work. So they kind of don't look at the numbers and go, do you know what? This doesn't work, because you want to be good at it. You like the idea of it, or you like doing it, whatever. I look back at that from school and doing A levels. I should have done biology, because I was really good at it, but I liked physics. I liked the idea of being good at physics. I did physics and didn't get such a good grade as I would have if I'd done biology. Similar type of example. Don't get sucked in by what you like to be good at. Just do what makes you money. There's no glory in taking hero ideas that don't work. You're better off to take 3 tick winners over and over and over and keep doing that forever than you are to take 50 tick winners once in a blue moon and then just get stopped out on a lot of trades. Then it really is just a case from there, continue refining. Taking anything live, I think, is always a difficult one to go, now's the time. What I would say on that, if you feel you've got to a point where you can realistically stay within a stop, you can also see that your performance is, if you track your equity curve is on the upswing, I think there's an element you have to go, look, this is good enough. There's never a perfect time. A lot of it for me comes down to confidence. So I think if you're questioning, is this the right time to go live? That probably suggests that you're not entirely confident in it. You need to have this element of being able to go, this will work. If you believe it will, even if you don't have the numbers to quite fully back it up, as long as you're coming from the perspective you believe it will work rather than you just want to be live, if you believe that you've got enough, I think it's worth going for it, and you're confident you can implement what you do consistently, then I think it's worth it.
And when you go live, let's say I could have an account of max 40,000. Would you first begin with a smaller amount, say 10, 20, in order to get used to the implementing the system, executing live?
Yeah, I don't see a great deal of value of starting with a bigger account.
Yeah.
If you start with a bigger account, great, you can take more risk. And so I've seen people do this before, and they start with like 200k account. And great, they drop half of it and they're down to 100 grand. Now, they might be able to afford it, great, but you've dropped 100 grand. It's only 50%, which is the same as dropping from 20 to 10. But nominally, that's still a lot more money, and there's no need to do it. Like, if you're trying to learn how to trade and you're trying to see if you can do this for real with real money, you're better off to start with 20 and build it up rather than being 100 grand of your own money when you don't need to. Because if you can build up from 20, that would be the same as building up from 200. And chances are you'll be able to build from 20 a lot easier. To build from 200, to feel like you're gaining any kind of success is going to be quite difficult, because you're going to have to trade more size to give yourself enough gain on the year to sort of go, that was worth it. And also it's a lot easier to end up scaling down. So, you come in with 200, you start trading a 10 lot or a 20 lot as your standard clip to start with. You have a couple of stinking days and suddenly you're trading a 2 lot and then a 1 lot, and then you're sort of floating around with 170 grand in a trading account. you can't see how you're possibly going to get back to 200 because you're trading one lots, and you're too scared to go back to 10s because you got absolutely toasted before. It's probably far easier to build up from 1s and 2s than it is to scale down from 10s and back up. Yeah, that's a real difficult thing to do. So yeah, on the whole, don't put in enough. If you're going to back yourself, put in enough to be able to trade a size that you want to be able to trade. Don't put in more than you need to. There's no real value in doing it. Yeah.
Otherwise you're overpaying to learn the same lessons, right? You're just paying more money to learn the same lessons.
Yeah, exactly. Yeah, nominally you're losing more money, but if you can afford it or not. Like, surely it doesn't matter how much money you've got. If someone said you can lose 100 grand or 10 grand to achieve the same thing, it doesn't matter who you are, you'd lose 10. But I think some people like the ego, being like, yeah, but I've got a big account, so I can do whatever I want, which often also runs the risk that then people start taking trades on and going, wow, I can afford to stay in this. And they sit in, you know, something like the S&P last week, and they sit long all week and then watch it drop 100 handles on Friday and go, well, I can afford it. If this goes again today, how much more can you afford it? You know, before it starts getting really, really dangerous.
Do you think it matters about like the psychology bit? Let's say you tried with like these online prop firms and stuff like this with bigger account sizes. So you start with a demo account with like 50 or 100,000, whatever. Does it matter, do you think?
What I would suggest on those kind of ones, because I know, yeah, you get a lot of these online prop firms now, right? You can have a 200 grand account. To me, it's not a 200 grand account. It's a completely made up number, because they limit whatever size you can trade. But ultimately, you've got a stop of, I don't know, 3 grand drawdown and you're out. So actually, you've got a 3 grand account. View it like that. Forget the amount of money to pay the margin and all of that side of things. If you can go no further than losing 3 grand, you've got a 3 grand account. View it like that. So these ones say, oh, we'll give you $1 million. $1 million what? I can't draw that $1 million out. So if I can't take it out, I don't have that in a trading account. The way I sort of view a trading account is, like I said before, it's a bank account with an overdraft. When you get so far down, unlike a bank where they'll come and say, we want some assets off you, you just get cut and that's it. So the other thing that's worth doing here from a performance risk perspective is not just, you know, can you make money with $1,000 stop on a day? Track the equity of your trading. So if you say start at 0, give yourself a number, call it 10K, which is probably realistic. I won't be able to suggest you go beyond that. Well, as long as you don't hit 10K down, it doesn't really matter what you do. If you don't go 10K down, you're still in the game. But if you find that, yes, you can trade and you can make money with 1,000 stop, but you hit streaks of losing days and you stop yourself out, again, that's still not viable. So I would look at it like that. One of the most important things is, can you recover when you're down? And the problem with a lot of these online prop firms is people get to, let's say, 2.5K down, and they're like, well, screw it. I'm either going to, you know, bash it long going into payrolls and I'm going to recover, or I just press reset and start again. And so there's no pressure on your performance there. You just go, well, it's a reset. You know, you're down to your last chip in a game of poker, and you just go on whatever, on the basis that you can just rebuy. And you know, if you front yourself 10K into a trading account, you can't rebuy when that's gone. It's gone. So I was just looking at it like that. Yeah, I'm not a big fan of these online ones. Oh, you've got this much money, so you haven't. It's entirely fake. The other thing as well is, not just with the online ones and that, once you're up, there is no trail drawdown on a trading account. If you're up on your trading account, the only trading drawdown is something you define for yourself. It's either back down to a point where you're negative, or it's whatever point you decide, I won't let myself drop back below this, and if I hit that, I'm going to quit. Very few people are that disciplined and actually do it. I think I probably know, I reckon one person who genuinely has had an equity drawdown on trading account, hit it and quit, and genuinely never came back, and he still hasn't. I don't think he will now. So yeah, impose those things for yourself. That's how I'd look at it. But yeah, that's probably the most key bits. Like, can you get yourself out of a hole? And don't just look at it and go, well, I'm going to start counting from here now, so this is now my new 0. It can't be. Whenever you get to the point of, right, can we take this live? Start at 0 and see where you get to. And see if you can recover. Almost everybody goes down to start with. There's very, very few people I've ever met who have gone up and never gone negative on trading account before they've made money. It's almost an inevitability. and being able to get out of that and being able to believe you can still do it when you're looking at a £5,000 down account and you're thinking, I don't know how I'm going to get out of this. Well, it's that belief in the stuff you do, the things that got you to the point of going live, which is what's going to get you out of it. If you can do that, then that sets you on the right step. So there you go. Right. That is a generalised question. What is your opinion about risk? It has got elaborated, so sorry, Grimy, I won't right, I'll add this question to the thing. Right. Okay. I'll go on to the next one, then I'll put the question on. Okay. Okay, so that was the one. Risk 1, reward 3, and scaling the target, 33% target, 50% target, 95%, and trail this last contract. But the net result will be a risk of 1, reward of 2. Is that so much of a question? Because I imagine if you've done that, then you probably know the maths of that better than I'm going to work out very, very quickly. But yes, I would assume you're probably right, because if you've got a outright 1 to 3 risk reward, i.e. you're risking 10 ticks for 30 tick winner, and you take the first bit out at 10 ticks rather than 30, then at 15, then 95. Yes, you're certainly going to get less than a 3 to 1 risk reward. And that's something that you have to look at over time. You have to look at the difference between what your target is and where you scale the positions out, because you can have a target of, it's a 3 to 1 risk reward. If you scale out very, very quickly, you're actually doing yourself a disservice. This happens a lot when people increase their size. So let's say you increase your size and your trades, we'll use a 10 tick stop again. You have a 10 tick stop, and this is a trade that gives you like a 30 tick target, all good. When people increase their size, one of the reasons that they don't go up too quickly and they usually flatline in performance is, let's say you've gone from a 2 lot to a 4 lot. What happens is you get in down here, and typically you would run your 2 lot all the way to target. What happens now is someone will get in and they'll see it bounce up and it will stall a little bit, and they'll go, okay, let's -1 there. And then it goes back to that same high and it doesn't go, minus another 1. And then they might run the 2 all the way to the target. So what you end up with is, yes, you make a bit more money, but you're not doubling your money. And that's usually where people get themselves in trouble, because you are doubling your loss, because you're still going to take all 4 to the loss. So then people's performance starts to go a bit flat. So their equity will do this for a bit. And it's when you get used to that bigger size that you then start to go up, because you actually take the trades for what they are. So yeah, I don't see there's anything wrong with this as an idea. And if the trade's got a 50-50 win rate and you've got a 2 to 1 risk reward on it, which is always a bit, you're never going to have no two trades going to be exactly the same, but that would still be a perfectly viable thing to be doing. Nothing wrong with it. But like you said, appreciate that you actually get a 2 to 1 risk reward, not a 3 to 1 risk reward. So don't sort of think that this is the greatest thing ever, because you're not actually getting that big a payout. And so then if this trade doesn't win as frequently as you think it does, or it's got a sub 50% win rate, that risk reward starts to get eaten into very, very, very quickly. And the expected value of that trade diminishes really, really quick. So that would be my sort of view on that. But yeah, that's what you see a lot when people increase size.
There's something you and I discussed about that simply off camera, like last week I think it was you said also then if you're tracking you just said earlier, your actual what happens in the trade after you get out, like how many of those are actually reaching your full target, and therefore could you take 50% of the ones where you're scaling, could you actually not scale because your consistency in achieving your actual target means that you've got evidence in data to give you the confidence to now hold your trades? Yeah,
I think that's really important. Or the alternative of going, well, you like this 30 tick target, that's a bit shaky, but it does 20 every time.
Yeah.
You're better off to go 20 every time for the whole lot than you are to go for the one that does 30 or more. That was always a strategy of mine on option expiries, that because they're quite regular in terms of when they happen, and the amount a market can move in 5 minutes is to a degree limited. that you would get a situation where, yes, occasionally you'll get one exceptional move, but almost every single one of it, the FTSE was one main one, almost every time it did 20 ticks, and you might get a 50. But if you kind of forget the 50 and go, yeah, but I can get 20 every time, the people who play for the 50 see it go 20, roll back, and then they start worrying because now it's only 10 on side, and they're thinking, well, should I bank? Should I get out? Should I not? Maybe it will still do 50. Whereas if you go 20 every time, you're always getting it. You just have to be able to be comfortable with that sort of opportunity cost that the one that goes 50 you probably won't be on. That said, the one that does go 50 will probably have something in it that looks different. So you, even if you've got out at the 20, you might be willing to get back in because there's something different on it. Right, there's a few other bits and pieces questions that came up. Not alone to say, over the period of course, I've had some decent days where performance in total ticks made across all markets traded is not well represented by P&L due to difference in per tick value of contracts. It's not just per tick value of contracts, but it's number of ticks. I think number of ticks taken is not the greatest thing to look at if you're looking at different markets, because you could take 200 ticks out of the NASDAQ on any day, particularly if you're only looking at quarter ticks. You try and find 200 ticks in the Bund, you're going to struggle. You know, you probably can't find a 200 tick day in the Bund in the last 6 months. You might find one. So there's no point. There's some value in looking at it per ticks if you're looking at the NASDAQ on a day-to-day basis, like what is viable number of ticks you could take out of a market. But don't add up multiple things together, because what you'll end up with is, you know, things like NASDAQ, gold, Bitcoin. You know, 20,000 ticks in Bitcoin last week. There's not 20,000 ticks anywhere else. So that completely muddies the water. Compare it day by day of different markets and what you can generally achieve, you know, what's realistic that you can get out of the NASDAQ, S&P, etc. But don't look at it as across the board. The thing you have to do there is, the question was, what's the best way to manage this? Do you just try to equate tick values across all markets? Yeah, essentially. And the way that you equate, you know, don't worry about comparison of markets so much, but try and make sure that you equate the size across markets. What you don't want is a situation where one market for you massively outperforms everything else. You know, if you trade the same size in all markets, whichever market moves the most number of ticks is going to be your biggest market by miles. Yeah, and so you've then got to try and manage that in terms of the size that you trade. Really, really important thing to do. Otherwise, what ends up happening is, I found this definitely in trading the DAX and the FTSE together, that I wouldn't trade the same, well, I trade roughly the same size in both. Basically, if I had a good day in the DAX, the FTSE was pretty unrecognizable. If I had a bad day in the DAX and lost money in the FTSE, it just added to a loss. And it always feels worse when you're adding to an already loss. There's no way that if you have a bad day in the DAX, I was ever recouping that in the FTSE. And that's not to do with the fact that I couldn't take enough ticks to do it. It's the fact that I didn't trade enough size in the FTSE, or traded too much in the DAX, whichever way you want to look at it. So you're better off to see it as you're not trading big enough FTSE. So you need to make sure you manage stuff in that way. Otherwise, you just end up with one outsized market that rules everything. If that is the case, you might as well just stop trading all the other stuff, because they're not really going to make a great deal of difference here and there. So make sure you kind of equate these. It's an easy thing to say. In practice, most people have a main market which they are always going to trade more than they probably, you know, statistically should trade. So yeah, there also has to be an element of comfort. If you're very confident in the S&P, then you probably end up, relative to others, trading slightly more size than you perhaps should. Straightforward way to work this one out. So I've done that there. I can send that over, or you can copy it down, or however you want to do it. You've got to do it as a kind of ratio. And the way I've done it is, what you're trying to get to is, if you trade one S&P, how many NASDAQ should you trade? And then scale that to something that makes sense. Simple way to do it, you do the ATRs divided by each other, which breaks down to then what is the equivalent tick movement. So at the moment, you're nearly on 5 to 1. 5 ticks in the S&P is 1 tick in the NASDAQ. Sorry, 5 NASDAQ is 1 S&P. Then you've got to multiply that by the tick value difference, or the ratio of tick value difference. So what you end up with is 0.2, roughly, is slightly over 0.2, I think 0.0203, blah, 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 lots of other numbers. And the ratio of tick size is 2.25. So that then gives you one S&P is equivalent to 0.45 NASDAQs, which is not very useful because, well, you can't trade 0.45 NASDAQs. This is where micros are helpful because you could then at least trade, well, you still have to scale it up. You trade in 20 micros to 9 NASDAQs. That's why you'd have to do it. So you get 1 to 0.45, and then you have to multiply up by the same in each to work out what the equivalence would be. So I've just done 0.45 times 20 gives you a round number, or as a single integer. And then if you trade that by 20, you times that by 20, so you end up with 20 to 9, if that's, and that would be the true ratio. Practicalities or practical reality of this, it's 2 to 1 would be the easier way of trying to look at this. There's never going to be a perfect element to this because your ATR is going to adjust. You can't constantly start adjusting this. You know, if you trade enough size, you probably could on a day-to-day basis adapt this, but it really isn't going to make that much of a difference. So yeah, I would just do it roughly. Yeah, you could almost roughly do it in your head to get to about the same number. Where it gets tricky is where you're doing something like Euro stocks to S&P, because then you have to factor in the exchange rate difference as well, just to add to the confusion. But Euro stocks to S&Ps, what, stocks is at 5,000, S&Ps at 6,000. So you trade 1.2 stocks to every S&P, but then an S&P is $50 to $10, which is about minus the exchange rate. You'd want to multiply, rather than multiply up by 5, you multiply it by 4. So you do 1.2 times 4, which gives you what, 5. So I'd do 5 stocks to one S&P roughly, would be the way that you do it. Like I say, you can rough maths a lot of these types of things. You're not trying to be perfect. You're trying to just make sure that you're not over-egging the size in one market over another. That's the key bit to it. I've also suggested this as well on account management, of making sure that, because let's say you're trading multiple different markets. You trade FTSE, you trade Bund, you trade S&P, and you trade Nikkei. You're going to end up with 4 different currency balances in a trading account. And what will then happen is that you get, on your trading account, you'll get a base amount, which is all of those converted into pounds, dollars, wherever you are. The way that I've always managed that, and people have different variations of this, I've always managed it of having a point where I would run a balance of dollars or euros or whatever to a point where a 1% swing in the exchange rate would start to impact my day. So, you know, if you've got an amount of dollars and that the dollar weakens by 1% and that could wipe out half of a normal day, I don't want that level of risk on currency. So I just convert it to pounds. And so you can just switch everything into pounds, you know, go to your base wherever you are, switch it into pounds on almost a numerical basis. You go, right, I've got 20 grand of dollars, switch them to pounds. Some people will just run dollar balances if they believe the dollar's going to strengthen. They'll just run all of their dollars and, you know, sort of play the long game. Personally, I've always said to you, if I want to trade currencies, just go and trade it. Don't leave yourself 500 grand of dollars in a trading account. I also saw one guy dug himself a hole by effectively switching everything. I can't remember which way he did it, but it was euros into pounds or pounds into euros. So he switched everything into pounds. So effectively gave himself a negative euro balance on the basis that, well, he's going to earn X amount of euros over the coming year. And so then you've already sold all your euros ahead of time. The problem that he ended up with was then the euro strengthened, so his negative balance got worse and worse and worse. I think just stay away from major like that. The other way that I've seen other people do it is they just do it on a weekly basis. It's like every week, just clear everything into pounds, just a week, and do it like that. It's up to you how you manage it, but it is something to consider over time, that you don't want a situation where the currency balance in your trading account impacts your trading. Nothing more frustrating than thinking, oh, that was an all right day. And then you come in the next day and think, I made nothing yesterday. How's that happened? I'll be honest, I only learned about that once I'd gone live and started trading oil, built up a dollar balance, and the dollar massively strengthened. And you sort of come in some days, I didn't do that well yesterday, and you've doubled yesterday's performance. And so fortuitously, I got to the point, I hope it's just my dollar balance is working rather well for me. Let's get out of that. So there was no real thought about how far I'm going to run this. It was much more, I didn't think about that, but I've made 50% extra on my dollars. not quite 50%, but it went from 2 to the pound to 1.3 to the pound. So it was a pretty hefty winner on that. So yeah, that's how I would do that. If so, does it change over time? I mentioned, do you trade similar trade setups which have similar expected values with equated size, or do you keep different markets independent? I think you've got to always trade things with a similar type of size. But the point that is important there is if you've got a certain type of trade that you take on, the structure of the setup, what goes into you taking that trade, is going to be exactly the same whether you're doing it in the Bund, in the NASDAQ, in gold, in oil, in S&P. The way it moves will be different. The size of your stop will naturally be different, that you can't employ a 5-tick stop across all markets because you'll just get pinged out constantly in things like NASDAQ, gold, and you're taking too big a stop in something like perhaps Schatz or T-notes that you don't need a 5-tick stop. And if you go 5 ticks offside, you already know you're well wrong by it. So don't have standardized stops on stuff as well. I know no one's mentioned that, but it is something that often comes up. Right, so I did miss this question. So there's a couple of questions I missed. So I will bring those in now. And oops. All right. Okay, so next couple. Can you discuss a bit about risk on small scalps or trades that come up too quickly, typically on a very small time frame? To do a full analysis, full-on risk analysis is discussed in the video. Is there a quick way to decide whether to take a trade or not when the full analysis will cause the trade to be missed? Are you kind of talking about sort of a scalping type approach? With scalping, ultimately, it's quite hard to assess the risk reward on scalping types of strategies. You have to look at that as sort of a longer term type of thing. That I'd almost go, right, well, at the end of the day, you still got to have a set level of risk. So you've got, let's call it $1,000 risk on the day. What I'd be looking at is what's your P&L at the end of the day? And can you link a certain type of day or way a market's trading to your P&L? i.e., are you really good at scalping trend days? Are you really good at scalping balance days? What is it that you're particularly good at? So that then you go, okay, well, this looks like a good day for me. I can up the size, I can reduce the size. Yeah, I think with any trade, if it's something that comes up so quick that you can't even sort of think through, and a lot of the things, the example I used about expected value, right? I'm not expecting people to go through and mentally add those things up all the time. The probability of it working versus probability of it not, etc. But you should be able to roughly do that in your head anyway. You're looking at a trade going, well, I've got a 5-tick risk on this trade and I'm getting a 2-tick winner. Am I really sure this is going to work? Because in the long run, if you're not really sure that's going to work, that's going to cost you in the long run. So whilst you don't necessarily have to work these things out, you need to at least be able to go, well, think of it in the longer term. That's the whole idea of looking at things from an expected value perspective. You're not looking at it in the immediate right now. You've got to ask yourself that, well, is this actually that great an idea? I think with any trade that you can't, even in the most basic level, go, my entry's here, my stop's here, and my target's here. If you can't answer that question and do the maths about how much you're going to lose versus make, you can't take the trade. It's not a trade, it's an entry. That's the way I try and think about those types of things. It's like walking into a shop with £10. You could buy something. Doesn't mean it's useful, it doesn't mean you want it, but you have the ability to buy something. You don't just walk in a shop and see the first thing for £10 and buy it, because you have at least some objective. Same with any trade. If you can't answer the basics of stop and target, it's not a trade, it's just an entry point. So that'd be the main thing on that. Would you use 2 separate demo accounts to try out extremely different strategies, i.e. some trades based on primarily on candles that I'd expect to play out typically within an hour or so, and another for attempting very quick scalps?
Could do, or you could just put it in Excel and tag the trades against the different strategies.
That'd be the main way. What I don't want to be doing is switching accounts. Just, if you've got an idea, just put the trade on and leave it be. And yeah, exactly like Peter said, just distinguish between the two. Otherwise, you end up with multiple trading accounts. You spend more time fiddling around with what account you're doing different things on. Yeah, if it's something like another way to try and do something like this, if you want to experiment with a longer term trading strategy, well, as I said before, all strategies should be the same in any market. If you play a reversal in a certain way, I don't know, you wait for an exhaustion and it does that, and then you play it up through the sort of little consolidation. Doesn't matter whether you do that in oil, in S&P, in Bund, in whatever, the trade's the same. So if you're going to experiment with doing these types of things, pick a market to do one thing in and pick a market to do another thing in, and do it like that.
The other thing is with two strategies on two different accounts, inevitably you're going to trade the wrong strategy on the wrong account at some point because that's Sod's law, and then you can't undo the data in those accounts.
Yeah.
If you do an Excel, you can just correct it very easily.
Yes, exactly. There you go. More good answers there. Yeah, just track your trades on Excel. You know, if you've done it on Excel, it also means that you have the data. You can go through and track it all. You whack it into ChatGPT and ask ChatGPT to summarize what strategies are actually best for you, and particularly if you put any commentary around it, what are the trades that you clearly feel you do perform better on or not.
Use ChatGPT to write your dashboards and reporting as well.
Yeah.
Do write some analytics on this for me, tell me what you want to see, and it will give you either the stuff to put in Excel or put in Power BI, whatever you want to do.
There you go.
So if you don't know Excel, you can just ask ChatGPT to do it for you.
That's a good thing with it. I've learned that a lot recently. It just gives you the answers to stuff. Yeah. So there you go. Don't bother with multiple trading accounts. All you'll end up with as well is becoming focused on P&L. Often the only reason people want multiple accounts is saying, oh, well, this one's up. Don't worry about it. It's an experiment. And like you say, if you're experimenting, just get on with experimenting. The goal here ultimately probably is to lose money, because then at least you can go, well, I lose money on that. Don't do those anymore. That's ultimately how you learn most things in life, that you do it, and it doesn't work, you do it, it doesn't work, and then you work out by process of elimination the things that you don't do that mean something does work. Think of it like that. Right, I think we'll probably wrap it up there. Loads more to say on it. I'm sure a few questions will start popping up in the week anyway, because it's usually quite a big subject, risk management. People get nice and focused on that. So we'll come back to it, I'm sure, at some point this week. Get your trade ideas in as well. I'd be really interested to see people put their trade ideas. It's a good way of testing risk management and stuff. Put your trade idea and we'll see if they actually work. So start throwing those in. It'd be really good to start seeing a bit more of that these next couple of weeks. We'll start bringing them up, going through and actually looking at how people's trades are played out. And hopefully be able to define where some people are better suited or where they're good, where they're not so good. Right, I'll leave you there, guys. Have a good rest of your day. I'll see you all tomorrow.